Please welcome Zions Bank CEO, Paul Burdiss.
Zero trust. Zero trust. The first time I heard that term, our cybersecurity folks came to talk to us and said, Paul, we need zero trust inside the bank. We need to invest in a zero trust architecture. And I thought to myself, I've spent 35 years in banking. Everything we do is built on trust. When people deposit money with us, they expect to get it back. They expect us to invest in the community and provide the money back. When people borrow money from us, they expect us to be reasonable, and they trust us. When people trust you with their money, it's one of the highest forms of trust that you have. And all banks are built on trust. And so for folks to come and tell me that we need to establish a zero trust architecture, I was mystified. But again, that's cybersecurity. They're on the cutting edge of technology. And of course, they made the investments. And for now, trust remains a really important part of our bank. So trust, as I said, is all about meeting obligations. When people trust us with their money, either borrowing or selling, they're trusting us to do the right thing. Banks have very thin operating margins. The difference between what we borrow, deposits, and what we sell, which is our loans, is for a good bank, 3 to 4%. 3 to 4%. A well-operating commercial company will have a margin of 30 to 40%. So how does a bank attract capital when the margins are so thin between what we borrow and what we lend? The answer is leverage. Leverage, borrowing a lot. We lever our balance sheet 10 times, as does every bank, 10 times. So the 3% margin becomes a 30% margin. In that way, we can attract capital from investors. This is a really important part because with leverage comes the opportunity for greater returns and greater risk. And so for a bank, a ripple of risk can turn into a tidal wave of problems. And so it's extremely important to manage risks inside the bank. And the application of technology in banking over the course of my career, which is the last 35 years, is significant. Banks are built on information asymmetry. Banks make money on the fact that we know more than you do about your creditworthiness. We're able to pool and aggregate risks. And you can imagine when we've got over 1 million customers, think of the number of transactions that counts in a day. It never stops, 24 hours a day. The only way we can manage that level of transactions is through technology. So banks are really at the intersection of trust and technology. And I'm going to talk a little bit more about that today. One of the key risks that we have as a bank is credit risk. Credit risk is the risk that our borrowers, when we lend them money, won't pay us back. And so there is a time-tested mechanism for understanding and thinking about what that risk looks like. We look at the character of the borrower, that's really important. But we also look at cash flows, we look at projections, we have these financial models that analyze these things and predict the probability of default. Well, historically that was all done kind of manually, but now, as you can imagine, we've applied a lot of technology to that. One of the more interesting things that banks are working on and trying to do is now taking it to the next level and thinking about a complete automation of the credit process. But for those of you who deal with this daily, you know that automation and learning are built on data sets. And data sets in lending are historically made by people, and therefore those data sets have an inherent bias in them. We as banks need to be really careful with that. There was just a large investment bank 5 years ago, had a very popular credit card, and they created this really cool, seamless process for underwriting credit. The problem was that the state that they were operating in accused them of having bias in their model because they claimed that they could produce outcomes that showed that the lending that they were making was biased, even though it was fully automated, even though there was no human attached, and even though I'm sure they worked really hard to extract bias out of the model. I think, if I remember correctly, they did not get into trouble for that. I think ultimately they were found to not have bias in their model, but it's something to think about. The positives and negatives, the double-edged sword of the application of technology to everything we do. On one hand, we can make things really fast and efficient. On the other hand, there are things that are inherent to what we're creating that may have downsides that we all need to be very careful with. Another example is operational risk. Operational risk for a bank is a loss that's typically due to a failed process or policy or some other thing. One of the biggest, interestingly, one of the biggest forms of risk is in payments. Technology has changed the payments business completely, particularly in the last 5 years. The safest way to move money is electronically. Debits and credits, it's all automated. It's very hard for a fraudster to insert themselves into the money movement while it's in motion, while it's in flight. Now, a fraudster can certainly attack you on the front end or the back end, but that straight-through processing of payments is extremely safe. But fraudsters are always out there, and they're always trying to make money. So what have they done? They have gone back in time and looked at checks. Writing a check is one of the most dangerous things that anyone can do, because checks inherently are riskier. People will steal checks out of the mail, they wash the name off, they replace the to themselves, and then they can find a financial organization that will cash the check, and it'll result in a loss for the person or for the bank. Now, for those of you who do write checks, and I recommend that you stop writing checks because it's actually one of the most dangerous ways to make a payment. If you're writing a check, though, use a pen that is a gel pen. A gel pen is very, very hard to wash. So again, old-time technology that's sort of forced the air in the balloon toward that because digital payments are just so safe relative to other forms. Cybersecurity risk, I talked a lot about that. Banks are always being attacked, right, from a cybersecurity perspective. And so you think about, well, what could we do to help cybersecurity? Artificial intelligence, AI. This is a great offensive weapon. AI can help us shore up our resources, help us to understand the risks, and help us develop and create a more secure wall around our customers' data. It's extremely important. The most important thing we have are all the data of our customers. So that's a great thing. That's a good thing. But the other side of AI is that the bad guys are also using AI. And so historically, when you're attacking an organization from a cybersecurity perspective, if you think of that in terms of being surrounded by a castle wall, those bad guys are pecking every brick in the wall, trying to find the weak one, right? Now, with the application of AI, they can attack every brick and every wall continuously and simultaneously. So it's really important that we're using the tools that are commensurate with the tools that people are using against us. So again, a double-edged sword. And finally, I'm going to talk a little bit about liquidity risk. This is, it's really important inside of a bank. Liquidity risk is our ability to meet our obligations when they come due. So think about all of our deposits. If you've got a savings account, a money market account, a checking account, those are all demand deposits. That means that you could come in and ask for all of that money at any time. But as you know, and if you've seen It's a Wonderful Life, there's a great scene in there that portrays this. All of the money is not in the bank, right? We've lent it into the community. Lending into the community, transforming our community deposits into community capital is one of the most important things a bank does. But if people lose trust, if they lose faith in a bank, what you'll find out is that people may come and try to draw their money out right away. So when we think about the risk to the bank, social media has completely changed the information flow. And it's not uncommon for incorrect misinformation to be spread around banks. And when that happens, people can lose faith in a bank. And so when we think about reputational risk and the application of social media to that, that is a big change for the banking industry, and one that we're all trying to consume. When you think of, if people lose faith in a bank, what they will do is they will, historically, line up outside the bank to take their money out. So think about that. You know, banks are designed a certain way because of the history of banking. In the past, when people lost faith in the bank, they would literally line up out the door. You saw that a lot in the 20s and 30s, you know, a bank run. But think about how a bank run works. You have to physically talk to somebody to get your money out. You need to line up and withdraw your money sort of $1 at a time. And banks have had, historically, kind of time-honored ways to control a situation like that, so until they get the information kind of back on their side. But now, because of technology, when you think about how great it is to be able to move massive amounts of money with a click of a button or a swipe of the finger, that's fantastic. And it's helped us all out a lot. The other side of that, however, is that if everyone tries to take their money out at the same time, that can be a really big problem because there is no mechanism to protect that. In fact, there was a fairly large bank west of here a few years ago experienced a run on the bank. They were raising capital. Capital raise didn't go well. People lost faith in the bank. But people didn't line up in branches to take the money out. People immediately started moving money electronically. And in the first time in my career, what I observed was that the FDIC, the Federal Deposit Insurance Company, came into the bank and shut it down in the middle of the day. The FDIC, to my knowledge, has never done that. The FDIC waits to the end of the day on a Friday. They'll come in and shut down the bank and take it over, and it'll open up on Monday. In this case, the money was queued up. The line to remove money from the bank was so long and all electronic that the FDIC looked at that and said, this bank will not survive today. This bank will not survive the next couple of hours. We need to step in and take it over. So again, the application of technology when we're moving money is great, but from a banker's perspective, we need to think about the risk. When people can move money immediately and they've got a deposit that is a non-specific maturity deposit, that money can leave us immediately, and it's a risk that we take very, very seriously and one that we need to manage very, very carefully. So, as you are thinking about the next big solution, as you're thinking about a technology application to a financial problem, I would just ask you to remember that you may be solving some level of risk and you may be introducing risk into the system. And so as I think about, and I'm asking you, as you're thinking about creating that next big solution, please remember that the solution needs to be holistic. So with that, I'll say thank you, Silicon Slopes, for having us. Zions Bank is a proud partner of Silicon Slopes. Zions Bank has been in Utah for over 151 years, and we share Silicon Slopes' mission to ensure Utah is the best place in the country or in the world to start and to grow and to scale your business. And a special thanks to UVU and President Astrid Tumenes. Thank you.